Every year, thousands of business owners all across the country overpay on their tax bill without even knowing it. And the reality is that their CPA or EA doesn't have the knowledge or skills to actually implement the tax strategies that are going to save them thousands. The government rewards business owners and investors in so many ways for engaging in the activities that the government wants them to pursue. And there are so many strategies available to reduce your tax bill, but if you don't know how to use them, then they are worthless. Today in this video, we're gonna be going over one of Tom Wheelwright's strategies that he talks about in his book, Tax-Free Wealth. He's Robert Kiyosaki's CPA, and he's helped his clients save millions in taxes over the years. Now first, make sure to subscribe if you're interested in more finance, investing, and taxes, business-related content, because I put this stuff out weekly for you every single Wednesday to make sure you're most prepared to run your business. And also, make sure you get a pen and paper and make sure you focus and listen to what is going on, because at first glance, this is a little bit of a complicated strategy. So let's jump over to the whiteboard and break it down. Great, so the tax strategy that we're talking about today has everything to do with business structure. And if you don't know about business structure or tax classification, let's break down the three main types that we have. So as a generality, most businesses are gonna be structured as an LLC, a limited liability company. This separates your company from you. Most people probably know that. From there, we have three different classifications that we can file our taxes as mainly. And these tell the government how they should view our taxes and how we get treated differently. Corporate structure and tax classifications is one of the most important things, and it is the foundation to how your business gets taxed, and you need to make sure that you are the right classification. So let's go through all three and break them down. So one, we have a partnership or a sole proprietorship. That being how you are taxed, not your liability. So that is under the LLC. Not to be confused with a sole proprietorship, which is a separate entity than an LLC. They're two different things. However, you can choose to be taxed as a sole proprietorship or with multiple member LLCs, a partnership. And what this means is very simple. The company has deductions for its expenses and the company has profits, everything that is left over. And you get taxed directly on those profits. There's a severe problem though. If you ever noticed, if you've been an employee, you have to pay something called your employment taxes, which is usually around 7.6%. Now on top of that, your employer has to match that 7.6%. Typically adds up to somewhere around 15.3%. And so before you pay income taxes, you actually have to pay your self-employment tax first. And taking 15% off of your tax bill right off the top is a huge hit. So how do we get around this? Well, that leads to the second classification, which is an S-corporation. And S-corps are great, and almost all small businesses should be operating as an S-corp. Now, I want to make a generality for this whole video. This is no guarantees on your tax bill, no guarantees with your investments. All of this is general advice for people out there running businesses. So not bold statements, any regulators watching. So the primary benefit of an S-corp is the fact that you can choose to take a reasonable salary out of the business and then take the rest as profit distributions. So how this might look is, let's say you run a dentistry practice and your dentistry practice makes $400,000 a year. Well, you can do is pay yourself as the head dentist, the owner, head dentist, what does that even mean? And you can pay yourself $250,000 as a salary, and then you can pay yourself $150,000 as the profit distributions. And the really big benefit to this is the fact that that $150,000 avoids that 15% self-employment tax. Now, a really important thing to note about this though is that your salary has to be reasonable. So it has to be whatever you would pay somebody else to do your job. And this is great. That's why I chose $250,000. Ideally, you would want to have that reasonable salary quote as low as possible to avoid that self-employment tax. However, you do have to be reasonable, because if the IRS looks into this and finds something that they doesn't like, they might say that that whole $400,000 is going to get taxed on self-employment, and you definitely don't want that. And then from there though, we realize that there's a problem, which is, what if we want to reinvest those profits into the business, right? Like, what if we want to use, say, 40,000 of our profits in future years to make an investment into more equipment, or we want to get more, I don't know, dentist teeth pullers, whatever. The problem is that no matter whether you take home those profits or not, they still get taxed at whatever your income tax rate is when you're using an S-corp. So there's a third classification that we can go under, which is called a C corporation. Now, C corporations are really cool because they actually have a classification strategy where if you keep the money in the business, you don't take it home, it only gets taxed at 21%. Or somewhere around there. I know it can probably change in future videos. But this is so important because if you are a growth company that is looking to go forward, your business could be making a couple $100,000 a year, and that's the difference between almost 40% in taxes and almost 20% in taxes. Here's the problem though, is when we take a distribution from the C Corp, okay, you get taxed once at that 21%, and then you get taxed at whatever your income tax rate is. And so if you notice the problem here, it's that you are getting taxed twice. And C-Corp has some other flexibility to it. For example, with the S-Corp, you can only have 100 shareholders, and there's some other things like that. With the C-Corp though, you have unlimited shareholders, you cut up the shares. Most big companies are C-Corps. So the idea behind the strategy that we're gonna talk about today is we are going to talk about how we can utilize both the benefits of an S-Corporation, you avoid self-employment tax, and then also the benefits of a C-Corporation where you can keep money in the business and have it grow only at that 21% tax rate. All right, so we're gonna jump right into how this strategy works, kind of the meat and potatoes of what we're talking about. Everywhere I see online people talk about the S-Corp strategy, it's really not that fancy anymore. This is really the next level stuff of that. Okay, so we're gonna keep using the dentistry earning $400,000 a year example for the rest of this video. Okay, and to make things very simple, we're gonna say that his effective income tax rate is 40%, which including state taxes is probably correct. And we'll say that that corporate tax is 21% or 20% or whatever. So we have to find a way to utilize both the S-Corp and the C-Corp, okay? So we're gonna make the main practice, okay? We're gonna make this a S-Corp. And this is super important, right? Because the dentist pays himself a salary, and we'll cut it down to make it easy. We'll say he makes $200,000 a year in salary and $200,000 a year in profit. So under a basic S-Corp structure, okay, he's gonna take 200 in salary, and he's gonna take 200 in profit, okay? Okay, so real quick, I just ran all of the numbers on this and what it's actually gonna look like for the dentist's salary, okay? So out of the salary, he gets taxed $30,000, and that's what his self-employment tax is. These are all rough numbers, okay? And then he's gonna get taxed $68,000 for his regular income tax, which gives him $102,000 of actual like salaried income. Notice that that's about a 50% effective tax rate, okay? Now, if we go over here, we have $200,000, and then he doesn't have any self-employment tax on that, but he still has his income tax. Now, as a note, these get calculated together, okay? Like when you actually like do your income tax return. These are just splitting it up so we see how things get taxed. And that leaves us with $222,000 in actual take-home pay. Wow. That's big. That's a lot. That we're getting close to a 50% tax rate. Like seriously, this is how businesses that are high profit operate sometimes. And the most large problem here that is going on is the fact that what if we want to invest $50,000? What if we want to invest, say, $72,000? Well, the problem is that we don't get to decide whether that stays in the company and gets taxed lower or not because we're under an S-Corp structure. Now notice this is way better than what would be like a partnership because they would have to pay that $30,000 on their salary and the profit. So we did better in the S-Corp, but we need to do something else. Great, so I simplified it here, just say $222,000 post-tax. Rough numbers, IRS, this is not actually what his tax bill is like. Okay, so from here, what we can do is we have to ask ourselves a question, which is, do we use vendors ever? Do we use vendors for compliance? Do we use vendors for payroll? Do we pay somebody to operate in their building, i.e. rent? Well, we might, okay, we might do those things. Likely we do. We likely have employees that do things for us. So we know that we have vendors, and we know that out of our $222,000, we want to transfer some of that money over to a different entity where it's going to get taxed less. So what can we do? What we can do is make a C-Corp, and we call this our, say, operations company. Okay, sorry, this whiteboard pen is bad, but this company is a C-Corp. And so what we can do is, and this is the meat and bones, make sure you pay attention to this part, okay, is when we have the C-Corp, we put all of our stuff, say we own the building that we're in, we put that under the C-Corp, okay? Say we have payroll costs, okay, and we have other different, you know, whatever, overhead expenses, filing paperwork, whatever. We put it under the C-Corp that does these things for us, marketing, whatever. And this company, we are going to pay an uptick to. We are going to pay them a profit. We're gonna do whatever it costs them that we typically pay, and then we're gonna beef it up. So let's say we typically have somewhere around 100K in operational expenses. Well, since this is its own company, if we hired a vendor to do this, we would have to pay them a markup on their services. So let's say they have a, you know, typical, you know, profit margin on this, and they're making another 50K in, they're making another 50K in profit. okay? This is super important. And we own this company. We're allowed to own this company. The IRS lets us do this. What we've just done, if you don't notice this, we have just moved $50,000 from what would have gotten taxed at 40% to being taxed now at 20%, roughly. And now I want to make a super important note on this, that this isn't like free money, okay? When you put it in the C-Corp, you're putting it into a business where it's meant to be used for investments. But now we have 50K in profit, okay? And that 50K in profit is getting taxed at 20% now, okay? But it's sitting in the C-Corp, which is great. And so now we actually have a couple different ways that we can use this money. First, let's break down what this actually looks like. So now, if we go back into our similar example, the dentist has a 200K salary, okay, which they pay 68K in income tax, and they pay 30K in payroll tax. Okay, now they have 150 in profit, which now this is only 60K in taxes. And the C-Corp has 50K in profit, which at that 20% is gonna be about 10K in taxes. So now by just doing that, okay, we now have $232,000 of after-tax income. And we saved $10,000. Now, I get it. It seems like a lot of work to maybe get $10,000 back. But we have a few things that really make an important difference here. So one, it's $10,000, yay. But two, that's $10,000 every single year. And on top of that, we can beef up and beef down this number. What do I mean? So let's say there's years where we want to invest more, okay? Well, the C-Corp can raise its prices, right? There's nothing like we don't have to only put 50K here. Now the thing is though, is what we have to keep in mind is with all of this, okay, we now have to use that for investments, okay? So we put 50K of profit into the C-Corp, okay? Yeah, technically we're supposed to pay 10K tax on that. What if we put a down payment on a real estate property? Now we have depreciation working with us. Like, that's all we had to do. We could put one down payment on a real estate property and like, boom, we're good. And you gotta keep in mind, okay, in the past, that wasn't exactly possible with the S-Corp, okay? It could have been, but there's limitations on how you can use real estate income to move against your earned income, okay? There's limitations there, but it is possible. And what I want you at this point is I want you to comment below what is the problem with this strategy, okay? If you remember it has to do with something said earlier in the video, has to do with the C-Corp structure, let me know what you think in the comments below what the problem is that I'm about to talk about. All right. We'll jump back in. The problem at hand here is the fact that C-Corps get taxed twice. So you might be thinking, yeah, it's great that they can invest this money, but what happens when they ever do want to pull it out? Now, there's a lot of other strategies that we can use to get maybe say around this. For example, you might have retired parents, okay, that are in lower tax brackets that you could give them ownership of your company to and they could take that money. Okay, the other thing that we could do is same thing with the kids. But you might say, I don't like my kids or I don't like my parents, so I want to take the money for myself because I'm a greed ball. Okay, in that instance, we say, well, we can loan this money back to ourselves and pay it a market interest rate. And dead serious, there are rich people that write themselves loans with this money and just literally never pay it back and they die with it. And you might have heard of buy, borrow, die. Like, yeah, that exists with banks, but there are people, and you can be one of them, that actually set up their businesses to where they just do this with themselves. And so what they might do is there are different things where you can make the loan at a certain interest rate and just say it's due anytime. What does that mean? Like, you don't ever have to pay back. Or you might do it to where it's payable, you know, down the road or whatever, a couple years. And then guess what you can do? Write a new loan back to yourself. Like, it really is money that you have free access to. And as long as you are smart with the investments will appreciate, they'll go up in value, and you'll just pay the loan back with that income. And so there are tons of strategies. You can just keep paying interest payments on the loans forever, basically. And it really doesn't matter because you're taking, say, 500,000 and you have to pay, you know, say 10,000 in interest, you know, whatever the rate is, every year. And it really doesn't matter because that money that you just pulled out is completely tax-free. And we can pay it off just by writing a new loan when the new money comes in. And rich people will literally keep on doing this like over and over and over again and just keep writing new loans. And it's seriously like crazy how it works. And keep in mind, when you write yourself that new loan to pay off the old one, you can take a bigger loan if you made more money. Now don't over leverage yourself, but that's how the rich operate. And so when I learned about this strategy, as I've been doing my study for my CFP coursework, it absolutely blew my mind. And I can't wait to implement this for my clients. But it is seriously so interesting how rich business owners and how investors play the tax game so differently than you do. If you found any value in this, make sure to subscribe. I post videos like this all the time, and make sure to comment below any questions you have this strategy. If you find a problem with this, if you think the government shouldn't allow stuff like this, let me know. I'd love to have a conversation about it. I personally think it's amazing that we give investors and business owners these types of breaks. At the end of the day, houses don't get built without these types of breaks. Right? You don't have the local restaurant that you love without people getting these tax breaks, in my opinion. We got to incentivize that as a society. So regardless, I'll see you guys next week in the next video. We're going to be talking taxes, investments, insurance, business, all types of it. We'll be breaking it down. See you in the next one. Thanks.